We'll walk through the process of calculating bond portfolio duration to measure interest rate sensitivity. This method covers individual bond metrics, market value weighting, and the final price impact on the portfolio. Duration is a measure of interest rate sensitivity. It estimates the percentage price change for a move in yields. The primary formula shows that the price change is roughly equal to the negative of modified duration times the yield change. For a portfolio with a duration of 5, a 100 basis point rise in yields results in a 5% price decline. So far, we've looked at duration fundamentals. Now we will walk through the calculation process. The first step is to calculate the modified duration for each individual bond based on its future cash flows. Modified duration adjusts the Macaulay duration to reflect the compounding frequency and current market yield. Next, we weight each bond. These weights must be based on current market values rather than par value or cost. In this million-dollar example, the contribution of each bond is its individual duration multiplied by its market weight. Summing the contributions of all 3 bonds results in a total portfolio duration of 4.73 years. We've calculated individual durations and portfolio weights. Next, we translate these into expected price impacts. A duration of 4.73 helps estimate value changes for specific yield shocks. A 100 basis point rise in yields would lead to an estimated loss of $47,300. We've covered the full calculation process. Now we'll look at the final checklist for accuracy. Always ensure you are using market weights and effective duration for any bonds with embedded options. The final portfolio duration remains a simple summation of weighted individual contributions. Calculating duration provides a clear view of interest rate risk, allowing for better management of a bond portfolio.